Cisco Systems. After announcing better than expected results a few weeks ago, Cisco is now trading at the highest level in 2 years. The stock price right now is $57.16 and gives us a dividend yield of 2.72%. Does this give us a good entry point to Cisco? Let's take a closer look at the earnings first, then look at some price targets. As a whole, Cisco's earnings were great, beating both revenue and earnings expectations. It was not a massive beat, but it was a good amount. Cisco posted a 16% increase in revenues as compared to the same period last year. Recurring revenue has been Cisco's new strategic priority, and by all means, that seems to be progressing well. The guidance was a bit mixed though. Next year's revenue is expected to be between $57 and $58.2 billion, a bit under expectations. The good thing is that the expected earnings of $4.01 to $4.08 per share match the consensus. The expectations for the next quarter are also slightly above expectations. It looks like the market reacted well to this. Cisco is up 8.07% in the last month. Cisco's stock price is gathering momentum too, outperforming the IT sector over the last 3, 6, 9 and 12 months. Cisco stock is above the 10, 50, 100 and 200 day simple moving averages, which means Cisco is in a steady bull trend. I'm sure you know that the trend is your friend, and that's definitely been the case over the last 3 months, as the stock went from $45.7 all the way up to the $57 we see today. That's obviously great news for existing Cisco shareholders, but what about price targets? Where can we expect that this bull run will take us? Like we saw at the start, Cisco is hitting a 2-year high of $57.16. Is this a good entry point? The average price target from Wall Street is $59.04. I know a lot of people are suspicious of these price targets, and I get that. They are a bit random sometimes, but they do give us some idea of the sentiment towards Cisco. The current price target gives us only a 3% upside, which is obviously not enough. On the high side, we have a price target of $73, compared to a $45 on the low side. Overall, most analysts rate Cisco as a hold, so it looks like most of them just want to wait and see what happens. My own valuation models are also a bit mixed, but let's break them down a bit. The Gordon Growth model shows a really low target price, but it only looks at dividends. Cisco hasn't really been active with dividend raises over the last few years, and that shows in the Gordon Growth model. Cisco has raised dividends, but the compounded growth rate has slowed down over the years. 9.5% over the last 10 years, down to 2.74% over the last 3 years. Obviously, we had COVID and the uncertain market conditions, which explains most of it. Despite that, projections for dividend growth remain low at 2.36% compounded annually over the next 3 years. I've used that 2.36% in the Gordon Growth valuation, so that's why we're getting a small value here. The EPS valuation model gives us a fair price, which is similar to the analyst consensus, only $58.8. Unfortunately, that does not leave us with any sort of margin of safety. The discounted cash flow models provide us with a higher target price. Now, these ones are a bit tricky. In the last 12 months, Cisco's free cash flow jumped from the usual range of between 10 and 12 billion to $18.3 billion. So, the question here is this: do we assume that the free cash flow will stay this high or not? If it does, then Cisco is giving us a good opportunity, even now. If not, then Cisco can quickly turn into a trap. This is really the big question here. Let's say that the free cash flow goes back down to 12 billion next year. The DCF target price drops way down to either $45 or $67.5. Suddenly, Cisco's current price of $57 starts looking a bit overpriced, or at least very close to the fair value. Personally, I think the free cash flow can drop back down, and here's why. Most of the reasons behind the higher free cash flow were not sustainable in my opinion. Compared to last year, there was almost a 2 billion increase in income taxes, 1 billion increase in unearned revenues, and 1.7 billion to do with changes in account receivables. These do not point towards better operations of Cisco. These just mean that there's some financial engineering going on behind the scenes. That benefits shareholders obviously, but it's not something that can be repeated again and again, which is why I think that the free cash flow will head back down next year. If I'm getting this wrong, please let me know in the comments below. The good thing is that even 12 billion in free cash flow still leaves Cisco with plenty of cash. Cisco only spent 6.3 billion on paying dividends, so dividend raises, more stock repurchases, paying down debt, these are all possible. Cisco has been growing dividends for 11 years, currently with a dividend yield of 2.72%. It's a good, high quality dividend. Like I said previously, expectations for dividend raises are low, but I think Cisco will exceed them. The payout ratio is also relatively low for Cisco too, so this gives Cisco a lot of options. Overall, how would I rate Cisco? I like Cisco, I like the stock, but I think that the price right now does not give us a lot of margin of safety. Plus, we're heading towards the resistance level of $59 and $64, which can be hard for Cisco to break. I think the company has a bright future, but I personally will wait for the price to drop. $53 or even $50 seem a lot more reasonable. Cisco has been on a steady bull run from the start of May, going from $45 to $57, a 25% raise in price. I think we are gonna see some sort of correction soon, and that's what I'm betting on. What do you think? Is Cisco a buy now, or do you prefer waiting for a better price? Let me know in the comments below and leave a like if you want to support the channel. Thanks for watching, and I'll see you again in the next one.